Hello, this is Bruce Wan, Head of Research for MaxCap Group. In this series of videos, we'll look to cover off a range of interesting topics from the world of real estate. Today's segment is focused on what we're seeing as the golden age for Australian real estate credit unfolding over the next few years. Now, I think it was Bank of England's former governor, Mervyn King, who famously coined the term NICE, or non-inflationary, consistently expansionary economy, to describe the Goldilocks conditions of strong growth and low inflation we've seen in many parts of the world since the 1990s. Well, those good old days are actually well and truly behind us, and the world has moved on to WINE, or what I would call wild inflation, negligible expansion. In this new world of low growth and high inflation, portfolio returns are lower, more synchronized, and a little bit more volatile. With these conditions potentially prevailing for some years to come, investors are looking into different asset class strategies to build better and more resilient portfolios that are more suited to these market conditions when growth is weak, inflation is high, and interest rates are rising. It is in this context we see a lot of investors turning their attention to Australian real estate credit for a number of reasons. Global central banks are lifting rates aggressively to fight inflation. There's a growing view, more and more reflected in market expectations, that rates are likely to stay higher for a longer period of time. Real estate credit, particularly where there's a floating rate exposure, remains a very effective hedge against these higher interest rates. In a world with more volatility and uncertainty, we see that Australian real estate values have been quite resilient over the cycle historically. This defensive resilience is even stronger for the credit position, which we see as providing more consistent incomes and less capital risk compared to that equity position. The low growth, high inflation environment that we are in right now is difficult for both stocks and bonds. Diversification is harder to come by, and investors are looking to other asset classes like private credit for that important diversification and that portfolio resilience. All of these factors, the rate hedge, the resilient incomes, the diversification potential, they're drawing more investors into the world of real estate credit and what we see as a golden age ahead for this sector.